1. Individual stock. Individual stock. This represents a tiny fractional piece of ownership in a single publicly traded company. When you purchase this asset, you are buying a direct stake in the underlying business, meaning your money grows if the company succeeds and shrinks if it struggles. It offers the potential for massive financial growth over time, but it also carries significant risk because the value can fluctuate wildly based on daily news and quarterly profit reports. 2. Government bond. Government bond. This is essentially an official IOU where you loan your personal money to a federal or local government for a set period of time. In exchange for borrowing your cash to build roads or fund public projects, the government promises to pay you back the original amount plus a fixed, predictable amount of interest. It is widely considered one of the safest places to park your wealth, though the financial returns are usually much lower than riskier options. 3. Mutual fund. Mutual fund. This financial vehicle pools together money from thousands of different investors to purchase a massive, diversified portfolio of assets. A highly paid professional manager actively researches and selects exactly which companies the fund should buy or sell, attempting to beat the average returns of the overall market. Because it requires active human management, investors are typically charged higher annual fees for the convenience of having an expert handle their money. 4. Index fund. Index fund. Instead of relying on a human manager to pick winning companies, this automated portfolio simply buys a tiny piece of every single major company in a specific market. By automatically tracking a broad list like the top 500 companies in the United States, it guarantees that your money grows at the exact same pace as the overall economy. This passive approach removes the risk of human error and features incredibly low administrative fees, making it a favorite tool for long-term retirement planning. 5. Real estate. Real estate. This tangible asset involves purchasing physical land and the structures built on top of it. Investors traditionally make money through this avenue by either charging monthly rent to residential or commercial tenants, or by holding the property for several years until its underlying market value increases. While it requires significant upfront capital and active maintenance to succeed, it provides unique tax advantages and serves as a powerful hedge against economic inflation. 6. Commodity. Commodity. This category covers raw, physical materials that are essential to global manufacturing and daily human survival. It includes precious metals like gold and silver, energy sources like crude oil, and agricultural products like wheat and coffee. People often move their money into these physical goods during times of extreme economic uncertainty, because their intrinsic value remains steady even if the global paper currency system experiences sudden inflation or instability.